Well, hello everyone. Bonjour tout le monde. Welcome to the Structuring an Investment Committee webinar, where our friends from Leith Wheeler Investment Counsel will dive into the governance of creating an investment committee, as well as understanding the roles and responsibilities and the governance of investment policies. It is so wonderful to have each and every one of you joining us today. And I am very mindful of how busy our weeks can be. And I'm also very grateful to share today's webinar session with you as we continue to move through growing and strengthening our community foundations. So please feel free to introduce yourself in the chat while I introduce myself to you and go over a few housekeeping items. For those of you that I've not met, my name is Tracy Vavrick, and I'm the Director of Learning and Network Engagement here at CFC. Today, I'm joining you from my home in Calgary, Alberta, Treaty 7 territory on the traditional lands of the Blackfoot Confederacy, the Tsuut'ina, the Stoney Nakoda Nations, and Métis Nation. I'm holding space for the learning journey that I am on in building my knowledge and strengthening my respect for reconciliation, and that my part is more than offering a land acknowledgement, but also it includes celebrating and embedding Indigenous knowledge and ways of being. I come with an openness to learn and to understand the truth and to honor the past, and actively build an inclusive and caring future of peace, friendship, and understanding. Now, joining us today are community foundations that operate from coast to coast to coast. And while we may be connecting from different locations, it's important to remember that we all have a responsibility, pardon me, we all have a responsibility to acknowledge the land and the original peoples of that place. And so thank you for being with us today. And I hope that you can take a moment to consider your own connection to the land and the original caretakers of where you live. Just a little sip of tea there to help with the just the unsteadiness of my voice there now. Always love when a tea can help. So again, I think I appreciate each of you for your commitment to explore ways you can continue to strengthen your foundation and how each of you work together and align as a team. So again, welcome and thank you for joining us today. So before we start our webinar, I've just got a few other housekeeping details to share with you. As you can see, we're in the Zoom meeting format. That's a tongue twister, but we're in the meeting format today to ensure that there's space for some breakouts, but also some Q&A time. And so that means you can see and hear, we can see and hear you, and you can see and hear us. So we do ask that you keep yourself muted during the presentations so that our presenters are able to share all of their thoughtful content with us today. And if you do have questions throughout the session that pop up for yourself, please use the chat box. We're going to be recording the questions that we see in the chat box and incorporating them into a Q&A at the end of today's webinar. This webinar will be recorded, and we encourage you to access the recording and the slides that will be shared with you via follow-up email, and please share them out with your team members. Share them with your fellow board members, share them with your other members that are supporting your investment committee and investment strategies. This session is available in both English and French, and so to access the French and the English interpretation, you'll see a globe at the very bottom of your screen. So if you click on that globe, you can switch between French and English. You will also be able to access the slide deck in both English and French. So at the top of the screen, you'll see View Options. And if you click on the arrow beside it, a panel will appear. And under Shared Screens, you'll see we're able to choose the view of either the English slide deck or the French slide deck. Now, I am absolutely pleased and so excited to introduce to you today the team that's working with us for this extremely valuable webinar. Today, we have Leanne Scott and Mike Baker from Leith Wheeler Investment Counsel. Now, Leith Wheeler Investment Counsel has been CFC's national vital signs partner since 2019. Thank you, thank you, thank you to the Leith Wheeler team for the ongoing support. Leith Wheeler is an independent money management firm that manages over $22 billion for clients across Canada. And within that, they do a lot of work with foundations, including counting over 100 not-for-profit and Indigenous communities as clients. This represents over $3 million in invested assets. You may recognize the names and faces on our screens today of either our speakers or other members from the Leith Wheeler team, because each of those members have been actively engaging directly with many of our community foundations over the years, or also have participated and supported other webinars and learning experiences. And so when you think back and reflect on today's presentation and time, also holding in your thoughts and your knowledge bank of the different and other resources that we've shared from the Leith Wheeler partnership and resources from in the past. You've also would have seen them as part of our team at the Victoria Conference, and we're looking forward to our up and coming event, Reconnect 2023, where again, we'll have the opportunity to share that time together and can do so as a result of the tremendous support from our Leith Wheeler Investment Counsel partners. So thank you again. So now let's move into the next part. We have two key leaders joining us today, and both Mike Baker and Leanne Scott are principals and portfolio managers with Leith Wheeler. And this is where they draw on many years of experience collectively together and independently in managing discretionary portfolios for foundations and families. The two also lead their respective practices, with Leanne is heading the Leith Wheeler's Vancouver office and Mike leading the Toronto office. In addition to both holding their chartered financial analysis charter, Leanne has an MBA and Mike holds the Family Enterprise Advisor designation. They are therefore well positioned to lead us in today's discussion about structuring an effective investment committee. So Leanne and Mike, thank you so much for joining us today. We appreciate you are here to share your knowledge and your expertise. And a reminder for our guests that are joining us today to please put any questions that you have as they come up for you today in the chat. And again, we'll come back to those as we move to the latter part of our webinar for the Q&A time. So I am absolutely honored now to turn today's webinar over to Leanne or Mike. Leanne and Mike, do you mind getting us started today?
Sure, I'll get us started. Thanks, Tracy. Hi, everybody. Nice to see you. I'm Mike Baker, and I live in Oakville, Ontario, and I acknowledge that Oakville lies on the traditional territories of the Wendat, Haudenosaunee, and Anishinaabe, and we recognize that these lands include Treaties 14 and 22 with the Mississaugas of the Credit First Nation. And February 2020, in fact, marked the 200th anniversary of Treaty 2022. We also acknowledge the many First Nations, Métis, and Inuit people who now call our town home. And we're grateful for the guidance of the Mississaugas of the Credit First Nation and the many Indigenous knowledge keepers and community leaders who've shared their knowledge on this reconciliation journey. So diving into some of the material. So previously, some of you may have heard us speak about building a resilient portfolio, which was in October. So we're building on that today. We're going to speak about what is a fiduciary from a high level. And please do attend our next seminar on March 1st, where we'll dig much deeper into defining the role of a fiduciary. We'll speak about the importance of an investment committee, how to develop a well-defined investment program with a robust structure, the role and responsibilities of investment committee members, the importance of creating a well-defined investment policy statement, or we'll often refer to it as an IPS. And before I forget, I'm very much looking forward to seeing you in person in June in Toronto at the upcoming conference. So let's dive in. Fiduciaries. What is a fiduciary? Well, a fiduciary is a person or an organization that owes the duties of good faith and trust to another. It involves being bound ethically to act solely in the interest of another party and in the other's best interests. So trustees, board members, investment committee members are all fiduciaries. And collectively, they're responsible for making decisions that are in the best interests of the foundation, including managing and protecting its assets, and they must operate in the best interest of all beneficiaries and not for the personal benefit of the committee members or any other stakeholders. We have a little comic on the side about what a conflict of interest is. So all of this includes acting with care and diligence and prudence and avoiding those conflicts of interests, either real or perceived. So perceived conflict of interest might be inviting friends or donors to act on behalf of the organization in a professional capacity. Doesn't mean it's an actual conflict, but it could be perceived as such, so it should be disclosed. So if we move on to the next slide on the importance of an investment committee. So the investment committee is charged with the responsibility for creating, implementing, and monitoring the investment program and seeking out the service providers required to administer and manage the investment fund. And they have three main functions. Return. So that's obviously to create an investment program to achieve the goals and objectives of the fund as a whole. And asset mix is the primary driver of long-term returns. So given the fact that investment management is filled with uncertainty, the most important decisions the investment committee members will make are in selecting and weighting various asset classes, stocks, bonds, cash, sometimes alternatives. So how to weight those asset classes and developing that asset mix policy and selecting an investment manager or multiple managers to manage those assets. The second function is to define the risk parameters. So the ability and the willingness to tolerate the risks that are involved in achieving the desired return objectives. There are many ways to define risk, and Leanne will speak about this in greater detail later on. Some broad parameters though. There can be a significant difference between risk ability and risk willingness. So the ability is typically based on facts and objective measures such as asset size, the income required from the investment portfolio, and is often considered over a very long time horizon. It's very rational, it's very calculated. Risk willingness, though, is typically based on human emotions and their attitudes and experiences, and it tends to be heavily influenced by short-term events. So an investment committee needs to establish both in determining the long-term asset mix. And they need to primarily focus, though, on the rational long-term as overriding the emotional short-term willingness. It sounds simple, but it's not easy. And in our experience, investment committees can overly focus on the risk willingness side of that risk reward equation. So short-termism sometimes, somewhat due to personal and reputational risk concerns, what's in the headlines, and so on. And the third main function of an investment committee is cost, simply to ensure the overall costs of implementing the investment program are reasonable given the expected outcome. So I'll pass over to Leanne.
Thank you, Mike. I'm Leanne Scott, and I am based in Vancouver today. If you could look outside, you might be confused and think it was nighttime because it's a typical gray day here in Vancouver. I would like to acknowledge that we live, work, and play on the traditional lands of Indigenous peoples, We want to express our gratitude for this ongoing privilege and acknowledge our responsibility as a firm and as individuals to further efforts toward reconciliation. Our Vancouver office is located on the traditional unceded territories of the Musqueam, Squamish, and Tsleil-Waututh nations. So now that Mike has discussed the importance of an investment committee, let's look at how to build a successful one. Right at the very beginning of developing your committee, your board will help by providing guidelines. First of all, they will define purpose and scope. And this should include clearly defining the committee's purpose and the specific responsibilities it will have in managing the foundation's financial assets. They should also establish rules and procedures and set clear guidelines for how the committee will operate, including such things as how often the committee will meet, how decisions will be made, and how those decisions will be communicated to stakeholders. They may also supply some guidelines on how to best identify and recruit members, which we'll be looking at in greater detail later. But overall, it's best to develop an even representation between members who have experience with investments, experience in the requirements and understanding of the beneficiaries, as well as a keen awareness of governance and fiduciary responsibilities. It's also a good idea to consider diversity and representation from different areas of the community. So now let's look at some successful attributes of a successful investment committee. A successful not-for-profit investment committee should have a number of key attributes in order to effectively manage the foundation's financial resources. These attributes include expertise. So members of the investment committee should have a good understanding of finance and investment principles, as well as some experiencing in managing financial assets. Diversity, I mentioned, it's very helpful to have a diverse group of individuals that can represent different backgrounds, perspectives, and areas of expertise. Objectivity, you would like your group to be as objective as possible, as this will help to avoid any possible biases. Collaboration, of course, you would like your committee to work very well together as a team, as this will help to enable them to effectively communicate and collaborate in order to make informed decisions. Strategic thinking will help you to achieve your foundation's financial needs and goals. Risk management is very important, as the ability to manage risk will help protect the foundation's financial assets. And last but not least is transparency. The committee should be transparent in its decision-making processes and communicate regularly with the stakeholders about the foundation's financial performance and investment strategies. So overall, clear and open communication is key to having a successful investment committee. So when you're looking to build your investment committee, the role of the chairperson is really critical. This person should have investment knowledge, that they should be able to run meetings effectively, and they should be able to bring in expertise from the outside when required. We get asked often about an ideal size for a committee, and there's not really a perfect number for this. Ultimately, the size of the investment committee will depend on the specific needs and resources of the foundation, but generally speaking, less is more. So if you have too many members on the committee, you can imagine that it can be difficult to reach consensus and make decisions efficiently. But if your committee is too small, while it may be more efficient and able to move quickly, it may also be less diverse and less able to fully consider all relevant perspectives. Therefore, we suggest consider targeting an investment committee membership with between 3 and 5 members, depending on the experience of the members. The more members with investment experience, the lower the numbers of members required. We do recommend no fewer than 3 members, however, as that can provide for diversity of thought and allow for the minimum checks and balances. Investment committee members, oh, sorry, I can go ahead. Not quite finished. Investment committee members are not expected to be experts on all things related to investing, as this would be not possible. And And also it's very helpful to review the committee's performance and effectiveness on an ongoing basis and make adjustments to the size or composition of the committee as needed. And now Mike is going to look at some common pitfalls or headwinds with investment committees that we've seen over the years.
Thanks, Leanne. So as Leanne mentioned, the most effective committees have members who understand the investment field. They grasp their roles as committee members. They understand the expertise required to effectively hire service providers to assist in developing and implementing the investment program, and they have the time to fulfill their fiduciary responsibilities. That said, there are several headwinds we've seen over the years that investment committees may encounter along the way, such as a lack of expertise. And while members may be brilliant in their own areas of expertise and may be well-educated and well-meaning, there could be a significant disconnect between their various fields and the knowledge required to understand the investment business. As Leanne mentioned, the most effective committees have at least one member who understands the investment field. And without this knowledge, it's difficult, if not impossible, for committee members to effectively formulate investment policy and set the standards for service providers linked to the investment fund activities. Time allocation and effort. So to be effective, committee members must put in the time and effort, not just for the meetings, but also to prepare for each meeting, which is as important as the meeting itself. You need to show up prepared. Conflicts of interest is a big one. If members of the committee have personal or financial interests that conflict with the interests of the organization or its investors, the committee may be less likely to make decisions that are in the best interests of the organization. So a common conflict I've seen in the past when I was in the consulting world for over a decade before joining Leith Wheeler was engaging local advisors or friends of the foundation to be professionally involved with the assets of the community. So the thought process is something like, these people are well connected in the community, they may be a significant donor or a friend of the foundation, and it's justified by keeping management fees inside the community. Now, of course, it's a conflict on several levels, independence, following a well-governed process, etc. But to drive it home, think forward to yourself to the point where markets aren't doing well, and would the board or outsiders question the wisdom of using one firm versus another? And would it be easy or difficult or awkward to make a management change? If yes, then maybe there's a conflict of interest at work. Groupthink. Investment committees can be subject to groupthink, where members tend to conform to the opinions of their group or to the loudest voice in the room rather than thinking independently, which can lead to a lack of diverse perspectives. Unconscious bias. So it's important for members to become aware of their own biases and take steps to counteract them, such as incorporating a variety of perspectives and conducting thorough due diligence. Here's some other biases and tendencies that can creep in. So analysis paralysis, otherwise known as a little knowledge is a dangerous thing. So just because something can be measured doesn't necessarily mean that the information gleaned from an in-depth analysis is meaningful or useful in evaluating the investment management structure or the money managers within it. So it's important to be selective with what's measured. The information gathered should be useful for evaluating decisions made at the policy level, the strategy that's in place, or the effective monitoring of the portfolio characteristics. So a little fun here, related to my comments just now on analysis paralysis. The diagram on the bottom right of this slide speaks to another bias. So in World War II, armor plating was scarce. So British engineers mapped the gunfire patterns on fighter planes returning from the front in order to decide the most effective placement of the additional armor. You can see that diagram on the bottom right, and we're going to launch a really quick poll here. So with the information on that slide or on that diagram, you see a bunch of red bullet holes. So with this information, where would you put additional armor protection? Would you put it on the wings, you put it on the tips, wing tips, the tail, the fuselage, or somewhere else? We'll just give it a moment and see how the poll results come in. Okay, so looking at the poll, we see a good variety of responses here. So if you said the wingtips, the fuselage, or the tail, or all of the above, you'd be wrong. The problem with zeroing in on the red dots is that this data is from planes that actually returned from the front. In actual fact, the planes that didn't return probably had the best data. Notice how there are 0 data points or 0 bullet holes on the engines. So this is a case of availability bias, where you'd have lots of data, but little of it's useful, or at worst, it could point you to the exact wrong conclusion. So the same can be true for investors, parsing the barrage of market data that's available. So it's important to avoid having the availability of data fool you into thinking it provides you with insight. So the last few here: lack of communication, understanding of the investment strategy and ability to communicate it. If the committee fails to communicate effectively with other stakeholders, such as the board, it may lead to significant issues. Lack of discipline. Committees may lack the discipline needed to stick to a well-defined investment strategy or to follow a robust process. So again, thinking back in the 08-09 period, when I was in the consulting world, the 08-09 was a very dark, negative period for financial markets. The most successful outcomes were with clients and foundations who followed the roadmap, their investment policy. They rebalanced when behaviorally, emotionally, it felt like the very worst thing to do. Some gave in to the emotion of the time, and they acted in a way that harmed the long-term value of the portfolio. They shifted to cash, they took money off the table. At the very least, in that environment, doing nothing would have been better than giving into emotion. And related to that point, emotions and short-termism, if you place too much emphasis on current events and recent past performance introduces emotional reactions or overreactions, that can get in the way of common sense and that disciplined long-term perspective. And the last one here, the Joey Tribbiani one, strategist versus fiduciary, also known as what hat am I wearing? So committee members over time may innocently forget that their role is that of an administrator, and they may begin to edge toward making decisions that fit more within the investment realm. They begin to think of themselves maybe as market strategists. Maybe they begin to second guess the investment decisions of the money managers. Yet they've got no process of measuring the success of their own actions. Investing is super easy when you're critiquing the actions of others with the benefit of hindsight. So investment committee members must always remember which hat they're wearing. It's the fiduciary hat, and they should avoid bringing their own personal bias to the table. So when do we change up the committee? Well, there's really no set frequency at which investment committee members should be changed. So the decision to change members should be based on the needs and goals of the foundation, as Leanne mentioned earlier, as well as the performance and the effectiveness of the committee as a whole. It may be helpful to review the committee's performance on an ongoing basis and consider making changes if the committee isn't meeting the foundation's financial goals or they're not operating efficiently. It could include replacing members who are no longer able to contribute effectively to the committee's work or don't have time, or adding new members with relevant experience or perspectives. So you would typically stagger membership rotations over 5 to 6 years or so, I'd say. In general, it's important to ensure that the investment committee has a mix of both some long-term stability, but also some fresh perspectives. And this can help to balance the benefits of experience and share the longer-term institutional knowledge with the potential for new ideas and approaches. So I'll pass over to Leanne to talk about the well-defined program.
Thank you, Mike. So there are several steps to developing a well-defined investment program. First and foremost is establishing your investment objectives, and these should be specific, measurable, and achievable. Next thing you want to look at is to assess any possible constraints, such as regulatory requirements or liquidity needs. And then, as Mike mentioned, risk tolerance. Assessing your risk tolerance is really key. That will determine the appropriate level of risk that your organization is willing to take on to achieve your investment objectives. And once you've determined these three, your objectives, constraints, and risk tolerance, you can determine an asset allocation that is appropriate for your organization. Then you're going to want to develop an investment policy statement, and this is a very important document. It should outline the foundation's financial goals and risk tolerance, as well as the investment strategies and guidelines that the committee will follow. Mike has a slide of an example investment policy statement that he'll share with everyone in just a few moments. Once your investment policy is in place, you'll be ready to select appropriate investment vehicles, which may be stocks, bonds, real estate, or alternative investments to meet your organization's goals. And finally, you'll be ready to select a professional investment manager. The goal here is to select a manager that you'll be able to develop a strong partnership with and who will be able to help you achieve your goals. So there are many ways to define risk, and I'm not trying to scare anyone with this slide, but as my mom used to say, forewarned is forearmed. The key thing to remember here is you can't avoid risk, but you can manage it. So we've just highlighted here some of the risks that you may encounter. Negative absolute returns. That's looking at a temporary decline in the value of your portfolio on your statement versus permanent capital impairment. Negative relative returns. This refers to underperforming the relative markets or the benchmark that you've established. Negative real returns, which is failing to maintain purchasing power. This is when your returns are not keeping pace with inflation. Volatility of returns. There may be some variability or short-term market value fluctuations. Liquidity risk is when it's very difficult to find a buyer for your investment, so there's a lack of marketability. Concentration risk is just what it sounds like. It's too much exposure to a single investment, which is not a great idea. You'll want to be sure that you're appropriately diversified. Credit risk refers to the risk that your investment is not able to pay their interest or the capital back to you. And reinvestment risk is referring to reinvesting your principal at lower rates than they currently are. We're all aware that rates have risen dramatically in Canada over the past year, but where will rates be in the next 12 to 24 months? For governance and stewardship, this ties into the strength of the committee and reporting risk. So you want to ensure that you're able to clearly communicate what's happening in the portfolio so that it's easy to understand for all stakeholders. And the blue box there is really important. It's not about avoiding risk because you won't be able to do that, but define it, understand it, and manage it. So once you've established your investment committee, developed an investment policy statement, and identified the various risks, there are some ongoing tasks to keep your investment program running well. First and foremost is you will need to continually monitor and review your investments. Ensure the asset mix and performance is appropriate and make adjustments as needed. ensure the investment management program is in compliance with the investment policy statement, and your investment manager should be doing this as well. You want to monitor and review your investment manager, understand and evaluate their investment performance compared to each manager's performance standards. It's always a good idea as well to monitor the investment manager's organizational update, as well as changes within the firm, including personnel, investment style or process, changes in assets under management and ownership. Communication, again, it's very important to communicate effectively with all stakeholders, such as the board, investors, and other parties, to ensure that they understand the program and its progress. It's important as well to be transparent about the foundation's financial performance and investment strategies. So the development of a well-defined investment program takes time and effort. It should involve a thorough analysis of market conditions, as well as the organization's risk profile. Additionally, it's important to work with a professional such as an investment manager to ensure that the investment program is properly structured and managed. I'm going to pass it back to Mike. He's going to look at investment policy statements in more detail.
Okay, thanks, Leanne. So the importance of creating that well-defined investment policy statement, it's all about governance. So the IPS is a document that outlines an organization's objectives, constraints, guidelines. This is the roadmap. This is the blueprint. So it's a critical tool for any organization that manages investments, as it helps to ensure that the organization's decisions are aligned with its overall goals and objectives. So we touched on this in our October webinar about creating resilience in investment portfolios. So a well-defined IPS is important for a variety of reasons. It establishes clear investment objectives. So by outlining the organization's goals, an IPS helps to ensure that these decisions are aligned with these goals. It provides a framework for making decisions. And an IPS provides that set of guidelines and constraints that the organization can use when making decisions in good times and in bad. This is the roadmap, and it helps ensure that the organization's investments are consistent with its risk tolerance and that it's not taking on too much risk. It also helps to ensure accountability. So an IPS helps ensure the organization's decisions are made in accordance with a predefined set of guidelines, which can then help to hold the investment committee and the investment manager accountable for their actions. And it helps avoid impulsive decisions. So having that well-defined policy in place helps reduce that possibility of emotional biases, impulsive decisions that won't be beneficial in the long term. And as a result, it helps to achieve better results. So by having that well-defined policy statements, foundations will have a clearer idea of their risk appetite, how they can measure success, and they can make more informed decisions to suit their needs, which results ultimately in better investment results over time. Remember, an IPS is a living document. It should be reviewed and updated periodically to ensure that it continues to align with the organization's goals and objectives and takes into account any changes in the long-term needs for the organization. It's not to be updated based on how we're feeling about recent results. It really needs to be about the long term. And I would highly, highly recommend use your manager to assist in setting up the IPS, in reviewing the IPS from time to time, and to understand what the critical elements are. So these are the typical sections within an IPS. What we would typically include areas and sections that determine that overall risk tolerance and risk appetite. It never hurts to actually put it in writing what risks you're trying to manage against, so that when the ultimate weak market comes along, that there are no surprises. It's been thought about what direction the committee will take in such an environment. It involves putting together a functional asset mix policy. It determines which asset classes should be included, which ones are appropriate given the size of the foundation assets to be managed, the desired target mix for each asset class, the band or the tolerance ranges that would trigger a rebalancing, and what flexibility an investment manager has to manage within those tolerance ranges. It sets performance standards for the fund as a whole, for each asset class segment, and for the money managers. And they oftentimes will include sections on policies around gifting, in-kind donation receipting. Oftentimes, especially more recently, the last 3 or 4 years, sections on environmental, social, and governance issues. And sometimes organizations will have specific constraints that they want to put in place as to, we do not want to invest in X. So on the next page, there's a bunch of portfolio performance inhibitors. So what this means is how we talked about the committee biases and what can impact committees. Well, what can impact the overall portfolios, and bias does come back in here. So again, make sure you're involving your investment manager in any of these investment related policy discussions. So unclear investment guidelines. So if guidelines aren't articulated well, they actually might be considered as constraints in the decision-making process. So properly constructed guidelines give your manager the necessary in-depth knowledge regarding the overall goals and objectives as they relate to performance expectations, risk tolerance, time horizon, and so on. Ineffective diversification. So hiring multiple managers doesn't ensure that you've got prudent diversification. It just means you've got more managers. So it's important to understand performance characteristics and when to expect outperformance and underperformance under different market cycles, under different market circumstances. And then you want to ensure you've got adequate diversification amongst styles. So I'll say this somewhat tongue-in-cheek, but it's the truth. If you have multiple managers and it's being done properly, one manager will generally feel somewhat disappointing at any point in time. A time mismatch. So time's got a major influence on investment decisions. The vast majority of foundation portfolios have very long time horizons before funds are required for complete liquidation. In fact, infinity in a lot of cases. So such a long time horizon provides an opportunity for the committee to take a longer term time perspective when formulating asset mix policy and strategy. And as we've discussed, it's very easy to get sidetracked by short-term events. Any short-term adjustment that's based on market movements or market expectations in the near term, any of those adjustments to the longer-term asset mix policy is considered market timing. And there are a few, in fact, there's probably no studies that have conclusively demonstrated that market timing adds any value to the longer-term rate of return of an investment fund. In fact, the vast majority of those studies say the opposite. The cost of market timing actually detracts from longer-term returns. So committee members obviously have to match the decisions they make to the longer-term time frame of the fund. And remember, check your bias, think about what hat you're wearing, and ask yourself if your bias is connected to personal objectives and time horizon. Sometimes around the committee room table, you'd hear somebody say, well, that's not what I would do with my money. Well, exactly. Like that's the point. It's not your money. It's the community's money. Different outcomes, different risk tolerance, different time horizon in a lot of cases. And the last one is just poor communication. The bedrock of a good relationship with your investment manager is effective communication. It should be done in an environment of mutual trust and respect and understanding and confidence between the parties. If the confidence level is missing, no matter how good the performance, it might not satisfy the investment committee. Well, meanwhile, in an environment in which communication is constructive, then poor short-term performance could be tolerated if the investment committee members have a clear understanding of the manager's style and why performance targets may not have been met given the environment, because the environment's constantly changing. So before I just pass up pass to Leanne to wrap up our prepared comments. I'd say that in my experience, an effective investment committee with a really well thought out IPS executed by a professional manager or multiple managers instills a high level of confidence from donors that their gift is being very well managed. And not only is it good governance, I've actually seen some organizations who will, quote unquote, market with this well managed or well governed approach. And they frame it in such a way that's seen as superior to how donors might manage on their own, thereby giving some framing around a discussion of donating now versus donating later. So with that, I'll pass back to Leanne.
Thank you, Mike. So in conclusion, first and foremost, we'd like to thank everybody for your time today. It really has been a pleasure for us to share this information with you, and we hope you have found it informative. We've provided here a summary of the key points that will help to build a successful investment committee. The first one, fiduciary standards. Just as a reminder, we will be hosting another webinar on fiduciaries on March the 1st. And on this particular slide, I think the blue box here is very important. Your investment manager should be your partner and should be available to help you at every step along the way. As Mike mentioned at the beginning, we're also looking forward to seeing many of you at the conference in June. And if you do see us there, please come up and say hello. And also, if there are any other questions or if anyone wants to ask anything offline, please reach out to us, as we'd be more than happy to answer any questions that you may have. So thank you very much again.
Mike and Leanne, I want to thank you so much. This was absolutely an amazing moment of sharing and learning. I'm mindful we're going to go into some breakout rooms now. And so I have our great team members here that will help us. And we've got some questions that we're going to focus on in throughout the breakout rooms. And then we'll come back for our Q&A and summary to close off today's webinar. So are we ready now to go into our breakout rooms? Mike, Leanne, you're ready to, I always call it like the Jetsons. We're going to like tour like the Jetsons now, and we'll pop into a room and see who we're with and have some tremendous discussion. So if we can turn to the next slide, we have our questions posted on the next slide. Oh, and I thought we had our questions there.
They're in the chat, so everyone can look at them there in English and French.
Beautiful. Thank you so much for that. And Sam, do you want to whisk us away?
Breakout rooms have been opened.
Beautiful. Thank you so much, Sam. Hello, everyone. Welcome back. I hope your time in the breakout room went well. I'm mindful that there was some opportunities for some great discussions, and some of the questions you have may have been answered during that breakout time. But I'd love to, if we could talk to each of our hosts that were in those breakout rooms to provide us with a short summary analysis of the conversation so that we can share with the full group out. So who would like to go first? I always believe it's an opportunity. Put your hand up. It's that Zoom quiet moment. Leanne, I see you went off mute.
I did. Yeah. No,
Okay.
I'm gonna go first. So we had a great chat. We probably could have chatted for another half hour or so, but we didn't have the breakout room questions pop up anywhere. So we didn't, I didn't bring them up because the members of the group had some questions to ask. So we had a great discussion. One individual is just starting their community foundation and had some questions about, you know, what she should be doing first. And we went through that. And then another individual was was wondering about reviewing the investment policy statement. It had been several years since they had done so. And, you know, I talked about how that's important, and it should be on the foundation's agenda every year to review the investment policy statement. There may be no changes required, and that's wonderful, but it should be something that should be front and foremost and on the agenda at least annually.
Oh, Leanne, thank you so much. And as you've mentioned, it's so important that monitoring and keeping it, as you say, front and center as a guiding principle for the organization. Wonderful. Now let's go to the next room. We've got a couple others. You know, Mike or Dallas or Mike or Mike. Who would like to go next?
I can do a quick summary, Tracy. Hello, everyone. My name is Mike Wahlberg. I'm one of the many Mikes on this call from Leith Wheeler today. And one of whom is through that wall, and Leanne is just through that wall here, just to orient everybody to where we all are in our organization this morning. So I'm in Vancouver. So we had a good chat. We actually talked about a couple of the questions that were in the chat here. So we'll probably get to those afterwards, but really we're focused on talking about implementing ESG specifically in smaller organizations, as well as having the conversation and figuring out kind of what kinds of things to focus on if you have traditionally had one investment manager that you've worked with who was local to your community foundation, talking about things like looking at the service offering, the fees, the performance process and track record, and just thinking about some of those various different things that community foundations can focus on to make sure that they have a robust process for selecting that investment manager. So perhaps Mike Baker and Leanne can get into the ESG stuff if that question comes up in the Q&A afterwards, but we'll leave it at that.
Beautiful, Mike. Thank you so much. And again, some of the key players and pieces that are important in that selection and that monitoring. And as I'm seeing a very strong theme of governance that's continuing to pop up today. We've got also Dallas or Mike Baker. Do you want to go next, Mike Baker? I see. Yes. And then Dallas will finish with you.
Sure. Thanks, Tracy. So in our room, the theme of governance actually came up, and it had more to do with the fact that there were some very large overarching committees, whether it was a corporate committee or in one case there was a finance committee, but there wasn't a let's say specialized or particular expertise from an investment perspective. So we discussed how to incorporate an investment committee to think about and to evaluate performance and ongoing needs of the organization in terms of risk management and how we can evaluate whether it's working or not. Because obviously people that are on our side of the table from investment perspective, we understand the performance and we can sort of communicate it however puts us in the best light, so to speak. So it's really try to have that objective view of how things are going, or what to expect from performance in certain environments.
Mike, you brought me back to a time when I was running the foundation that I was leading, and one of the areas that when we looked at the investment committee is we knew it was important to have representation from the board, and it was usually the treasurer that was part of that. They come with that financial background, etc. But we also reached out to the community, and majority of the committee were community members that brought that expertise to the table, and we're not at a conflict of any sort. And that takes work, it's time, but I'm mindful you had that discussion and the importance of it, because it is a place that is important when we start to look at that overall governance aspect of leading not only the policy and the objectives, but the responsibilities to stakeholders, including the board and the community. Thank you again there, Mike. I'm going to move to my fellow Calgarian, Dallas. So beautiful to see you. Welcome. And I know you were in with one of the breakout rooms as well. Would love to hear reflections and thoughts from your moment as well.
Yeah, sure. Hi, Tracy. Nice to see you as well. Thanks for having us, everybody. We had a good discussion in our breakout room. Unfortunately, we didn't have the questions on hand either, but nonetheless, a couple of the groups in our breakout room are either fairly new or just kind of getting started on this process of forming an investment committee and whatnot. And so for one in particular, it was really nice to hear that this presentation gave them confidence that they've been going through all of these steps. They really feel like they've hit the mark in terms of how the committees have been struck and the types of expertise that they have around the table, which is really good to hear. But then there was also some conversation on the flip side that when you're small, it can be very difficult because you're wearing a multitude of hats. You're probably a couple people sitting on various committees, but kind of thinking from the same point of view. And so there was some discussion around, how do we go out into the community and potentially find those individuals that could help add some diversification around the table in terms of experience or thought. So, maybe something for us to keep in mind for future presentations. How do you find those individuals?
Dallas, thank you for that. And it's I appreciate the importance of, again, getting to that selection of the expertise, understanding fiduciary responsibilities and et cetera. But how do we build that body of resources and people to support the work? And I'm going to go into the Q&As for a moment because there was a question that was popped into the chat that reflected on that, and I'd love to take a few moments to dive just a bit deeper on, when we've got a smaller community foundation with under 100,000 population, would it be advised to have local investment committee members but not a local investment manager to avoid the conflict of interest? So thinking broadly of both and how that fits. Who would like to approach this question for me? I'm going to say I have 3 mics I could pick from, or Leanne or Dallas. Who would like to go?
You want to take it, Leanne?
Sure. Yeah, so sorry, I'm not able to see the questions anymore. So they're wondering, they're in a smaller community, and if, while their investment committee is local, if they should have perhaps an investment manager outside of the community to avoid any potential or perceived conflicts.
It is. Yes, it is, Leanne. Thank you.
Yeah, I mean, I think it's a good idea. I think that's a good idea. It's not absolutely necessary, but it definitely would help to alleviate any perceived conflicts of interest. The person that they decide to work with, the investment management firms they decide to work with, I'm not sure where they're located, but they should be willing to come and visit, the foundation a couple of times a year. So I don't know if that's prohibitive. I'm not sure about the distance, but it would certainly, get rid of that conflict. Not 100% necessary. I think it's more, what we've been referring to is there may be an investment manager locally that is good, but there are no ties with, if you know what I mean. It's more the conflict in terms of ties. And then, as Mike Baker mentioned in the presentation, if you get down the road and it becomes apparent that perhaps it's time to change your investment manager, having a local person that you have close connections with, that conversation can just be that much more difficult or awkward.
I'd add to that as well, Leanne. It comes down to having an effective process for selecting your investment manager. So you might be able to invite someone who's local to your community, who doesn't have conflicts with the community, to participate in a process, but they would be perhaps one of several that you invite to pitch for the business, including people from management firms from further away than your local. That way, at least you have a robust process you can point to, that you followed a governance process, and that if you select your local person, then it's a defensible decision in the end of the day.
Yeah, that's a great point, Mike. And we talked about that in our breakout room, how that when you're selecting an investment manager, you should invite at least 3 you know, 4 or 5 people to come and meet with you and ascertain the best fit.
Thank
I'll
you.
just add I'll add one thing to that as well, which is the experience of the firm you're working with, I think, is important. If you're in a small community or there's not a ton of experience around the table, working with a manager who's has experience working with not-for-profits and foundations and endowments who can help guide you through the process and can help with those reviews that need to happen from either a policy perspective or a governance perspective, and who can potentially leverage off of existing client experiences. I mean, we don't have all the answers, but when you work with a lot of not-for-profits, you do find some interesting ideas and some interesting concepts creeping into investment policies that make a lot of sense across the board. So that you can bring those, like an experienced manager can bring some of those proactive ideas to the table. There's a big disbursement change coming up, as you all know. So there'll be a lot of discussion around that over the next little while.
This brings very fitting to the next step of the questions that are coming in, and it's down to the process. So we've, looking at the committee as a whole, but now stepping back for a moment and being mindful that we've got many new foundations that are just being established or have been recently or just developing systems and policies. And so looking at the aspect of moving towards an investment policy objective, moving towards a finance or an investment committee, where would a starting point be for someone that's brand new, that has identified we have this gap, we don't have our investment policy objectives in place? So how would, using the framework you provided today, you gave some great steps on here are the pieces that are needed. But would they formalize first a committee, or how would they look at those objectives so they can provide a clear path for when they do move to hiring a manager, that they're prepared? Where is the starting point at the basics of just starting a community foundation and starting an investment portfolio?
So I can jump in, and then anybody else wants to jump in afterwards, that'd be great. But obviously, board first. Make sure you've got a decent board of directors. Then from that board, probably a subset, establish the investment committee or finance and investment or finance and audit committee. But ensuring that you've got probably one person in that group who has specific investment experience, if possible, so you can start thinking about then generating a policy. At that stage, understanding that it's a small community foundation, I'm not sure that you'd want to necessarily hire a consultant. There are a bunch of investment policies out there in circulation, I'll say. If you look at either community foundations or religious organizations, they often put their investment policies on their websites. So it can give you at least some guidance as to a decent place to start with the verbiage and the framework, rather than starting from a blank piece of paper. So that's what I would suggest.
Wonderful, Mike. Thank you for that. I'm not certain if anyone else has anything else to offer. I do echo your comments, Mike. We have a tremendous resource within community foundations. And one of the values of the network of 205 foundations is the openness and the care to always share and to learn from each other. And we have, as you know, various groups from our finance group and our executive director groups, etc. And so great opportunity to leverage that sharing point as we have. And we also as well have on our website a guide, which is an administrative and governance guide book that's available. There are some key points in regards to the looking at a investment committee and investment structure as well. So those are other key places too that our members can explore. And so before we close off, I have one more quick question for us, because I'm mindful of the time as I see here, but we have a question that's come in around ESGs. And so again, coming back to the presence of a smaller foundation, say under that $10 million, and how can a smaller foundation look at either ESG or impact investing? Is there a way that a foundation could start to explore incorporating either the ESGs or impact investing in their portfolios when they're under that $10 million?
I'll start and then all the mics can hop in here and Dallas. But yeah, no, definitely. Even when you're starting out and if you're a smaller foundation, if ESG is important to you, it should be, part of the be incorporated in your plan, and it should be asked of your potential investment manager. You should ask them outright, how do they incorporate ESG into their investments? And be comfortable with their policies and practices and how they invest. There has to be a high level of comfort there.
Wonderful. Leanne, thank you for that. Any other comments, Dallas? Do you have comments as well?
Sure. Yeah, I would just add that, part of the fabric of what we do for clients, whether it's foundations or individuals, is before we're building out these structures, we're really getting to the crux of what's important to this client or this foundation. What are those specific values or concerns or, gaps in knowledge that we need to address? And so from an ESG perspective, there's a lot of glossy language out there, and there's a lot of really, really good intentions. Ultimately, some are very achievable in a well-structured portfolio, and others are not as easy to implement, or they have risks of their own. So, just like Leanne said, really, really important that we sit down and have these conversations, and that, you have a very, very good understanding of what the investment firm or the individuals that you're working with focus on in this respect, and, how we can try to fill in the gaps between the ultimate aspiration at the end of the day and what's, prudent. Yeah.
Wonderful advice, very wise advice today. And I am so grateful to have this tremendous team from Leith Wheeler Investment Counsel joining us today. You have shared so much insight. You have provided guidance on ensuring community foundations really move towards the direction of a strong governance structure around their investment committee structure, on their investment committee objectives, but also looking at ongoing into the future of monitoring and ensuring that there are controls in place to meet the objectives of the policy, and to be mindful, to be careful not to react, not to go to that place of reaction, and not to go to that place of groupthink or conflict of interest. So today's session was extremely valuable, and some very key points for all of us to add to our resources and tools as we continue to operate and ensure we're doing the best we can with our fiduciary hat, and also providing amazing impact for communities. Apologize, I'm on a new Mac. I'm learning how to turn noises off. Really appreciate also the time that we took in the breakout rooms and the great discussions. And as we get ready to close here today, we do have a quick poll. So we just ask for everyone, take a moment and complete this poll. This will help us to ensure that as we are moving ahead, that webinars and events are informative and of interest for our network and our members of CFC. And in addition, we are placing a fact sheet in the chat, which is, it will be, it's a great resource. This fact sheet that you see has been designed with the team of Miller, or pardon me, sorry, I apologize. I was thinking law for a moment. That was not right. Leith Wheeler, to help us in regards to continuing to use these resources and have the fact sheet available for us to use with our boards and also our committees and within our operational structures. So grab that fact sheet, share it out with your teams. In addition, tomorrow we are kicking off Vital Signs with Vital Signs 101. And then on February 8th, we have a CGE webinar, which is our Community for Gender Equality webinar on gender lens investing, which is specifically constructed for community foundations and opportunities to explore. So we are excited to continue to hold space together. And so continue to watch the link that was shared in the chat and as well as our website. And in addition to my newsletter that you receive once a month, which includes events and upcoming resources. And if you have not registered for any of these that I've just mentioned, just go into the website and you can do so now. Thank you, everyone. Again, tremendous gratitude to our Leith Wheeler Investment Counsel team. We appreciate walking the path that we do with you and your ongoing support, but as well for your great insight and guidance today, and a deep appreciation to all of our members that have joined us. So take care, everyone. We look forward to connecting again soon.
Thanks.